Hello, everyone, and thank you for joining us for this panel today, hosted by the Turkish Investor Relations Society. It's such a great pleasure and an honor to participate again in this year's Sustainable Investment Summit on behalf of the United Nations Sustainable Stock Exchanges Initiative, or the UNSSE. I'm very pleased to be moderating this session, which is titled Measuring Stakeholder Capitalism, the Importance of Aligning Existing Frameworks. Our vision at the UNSSE is a world where capital market signals align with public policy goals and sustainable development. So as you can imagine, stakeholder capitalism is close to all of our hearts. Stakeholder capitalism is becoming an increasingly mainstream topic. In 2020, the World Economic Forum themed its annual conference in Davos, Stakeholders for a Cohesive and Sustainable World, and it indicated that its objective was deliberating on pathways to stakeholder capitalism. Now, the use of this term stakeholder capitalism aims to indicate, I think, a shift away from the paradigm of shareholder capitalism, which some would say has guided our world economy since the 1970s or even before. But in theory, this term is still hotly debated. However, in practice, we can really dig a bit more into that. And we have here with us today two experts who know firsthand the important role that stakeholders play in our current capital market system. And more importantly, they're both playing very key roles in identifying how stakeholders can be engaged with as the underlying values of our capital market system. So on this panel today, I'm very pleased to be joined with two great panelists. First, we have Neil Stewart, who's the Director of Corporate Outreach at the Value Reporting Foundation. And for those who are not familiar with this organization, the Value Reporting Foundation is a global nonprofit organization that offers a comprehensive suite of resources designed to help businesses and investors develop a shared understanding of enterprise value. Importantly, they are key components of the recently announced International Sustainability Standards Board, or ISSB, at the IFRS Foundation. So we hope to hear a little bit more about that today. Additionally, we have with us today Michael Underhill, Chief Investment Officer and CEO of Capital Innovations, and the author of the Handbook of Infrastructure Investing, as many more things as well. But both Michael and Neil have deep-seated knowledge of this topic we're discussing today, both on the side of stakeholder capitalism, as well as on the side of alignment. And I'm eager to dig into their knowledge. So let's get straight into it. The first topic I'd like to discuss with you both, if we may, is the shift from shareholder capitalism to stakeholder capitalism. So let's talk about what's driving this, what's behind it all. Michael, if I can start with you, I'd like to ask, well, stakeholder capitalism may be a much more mainstream saying now. When you started working on impact investment, it was much more niche. So what do you think has led to this growth moving from niche to mainstream? And in your experience, what have been the key drivers behind this shift?
Yeah, well, Tiffany, thank you very much. And Neil, pleasure spending some time with you today. You know, that question, I think about the convergence of things, right, over the last few decades and what we've had in terms of moving from shareholder to stakeholder capitalism has been a tectonic shift, even a sea change. Because you've had multiple issues. You've had issues over the last 30 years as an investment professional I've seen, or 3+ decades. You know, we've seen issues with corporate governance. We've seen issues with valuation. We've seen issues with environmental issues. I mean, massive issues. And I was reading yesterday about India and Union Carbide and the fact that they have not yet cleaned up the Union Carbide site, where there's a massive environmental accident which cost numerous lives, and you look at that decades ago that occurred. You look at some of the things over the last 30-40 years, in terms of environmental degradation, fossil fuel companies, some of the things, whether you're talking about British Petroleum and some of the things that happened in off the coast of the US, or some of the other great environmental disasters that were the collateral damage of the lack of corporate governance, the lack of adequate business planning and disaster recovery and other types of business continuity and compliance issues at the corporate level that have led to massive environmental issues. And then we look at the supply chain and think over the last 3 to 4, 4 to 5 decades about the supply chain, about sourcing materials. And whether you're talking battery metals or fabric for clothing or any types of consumer durable or even non-durable goods, some of the things that are going on with companies, the analysis of the supply chain, the analysis of labor that goes in, child labor, as well as fair and humane treatment of labor that goes into that material supply chain that creates literally the fabric of our world, and how people are treated. And you look at some of the things that are going on, all of this over the last few decades has really been intensified, become more granular because of data. And as a data scientist and responsible investor, we've gone from SRI in the 90s, socially responsible investing, to call it mid 2005 sort of impact investing. ESG was really the phrase that was coined, and larger pools of data were available to manipulate and utilize for measuring and benchmarking and trying to manage what we measure. And I think even now we're looking into 2022, you have so many different aggregate pools of data in which we can take this data and interpret where we're putting our capital to work, how companies are using their capital internally. And when you look at the opportunity of a company to pay dividends, execute strategic acquisition, invest in R&D, increase salary or wages, and pay a more humane and responsible wage, as well as improve living conditions for their employees, as well as some of their fundamental businesses, I think we've moved considerably further down the road from shareholder to stakeholder. We have larger and more granular data sets that help us make more informed decisions as professional investors. And I think some of the different vehicles out there we can talk about, they're really helping people put their capital to work in a more thoughtful way so they can make a more informed choice. And so fund managers and fund sponsors with ETF, passive, other types of product can actually invest and move from shareholder to stakeholder based objectives. And I think now we're just starting to see this pick up. And by that, I mean, I look at some of the money that's invested in ESG mutual funds, ETFs, passive vehicles. And if you look at the forecast over the next 20 years, the AUM of those ESG focused vehicles is forecast to grow 20x according to Morningstar. So I think we're early innings of what's going to be a very, very long and productive and fruitful cycle of investment, thanks to that transition from shareholder capital to stakeholder capital. But we're just getting warmed up here. So I know you asked a few questions. I gave you a dissertation. Let me just stop there.
Great. Thanks, Michael. If I can just follow up on one thing, I noticed a lot of what you were saying was really strategy oriented. So risk opportunities, enhancing our strategy and planning with new data that we didn't have previously. What amount of this do you think is pertaining to enhancing our strategy and doing better business? And what amount of it do you think is more of the impact side of ensuring we're having more positive impact on our environment and society?
Well, I think it's neither. I don't think it's an either or proposition. I think they're mutually exclusive, and I think the companies that are publicly traded companies seeking to attract capital, and even some of the private companies that are seeking to attract capital, they understand that sustainability and stakeholder capitalism is much. It's not only the right thing to do. It's what's going to benefit the company longer term. It's going to benefit the employees longer term. It's going to help them as an organization seeking to raise capital in the capital markets, is going to help them draw upon capital markets, public or private, and they can actually go out to the market with a more sustainable business model that serves their stakeholders. the stakeholders and shareholders will understand it, it becomes a more virtuous circle. So they're more inclined to invest in these companies that will be more productive. And admittedly, a world in which natural resource scarcity is one of the biggest issues we're faced with today and on a global level.
Great, that's very helpful. Thanks, Michael. Neil, Michael mentioned convergence, so let's build on that a little bit more. As demand for new information grows, the variety of frameworks and standards are growing, but now we're actually seeing a convergence, which is great. But what in your experience has been the main driver of this and the consolidation? And can you give us a bit of an overview of what's happening?
Thanks, Tiffany. And this is such an important question, particularly for this audience of investor relations officers. It's a huge pain point. That is the competing demands, often overwhelming demands from different sides, different stakeholders, and with different information needs, and all this patchwork of frameworks and standards, but also ratings and rankings, surveys and questionnaires, indices, and so on. It can be really overwhelming, especially for smaller issuers with limited capacity, limited personnel. We've got to solve this. We've got to get to a much more simpler, streamlined system that is cost efficient for preparers, for businesses, and also decision useful for the users, particularly for investors. And this is, let me pick up on a point of Michael's, this need to mobilize capital. Now, at the time that the International Sustainability Standards Board was launched at the big UN climate conference in November in Glasgow, COP26, it was also announced that there was a new coalition of investors called the Glasgow Financial Alliance for Net Zero, $130 trillion in capital committed to net zero goals. At the same time, the International Sustainability Standards Board was launched, and it was heralded as the plumbing that was going to get this capital flowing. Investors need information to base their investment decisions on. They need to be able to compare one company to the next. That means a common language. Up until now, we've had this patchwork of different languages. Now we're getting to one. And so the no significance convergence is the International Sustainability Standards Board taking essentially 5 standards and frameworks, the 5 standards and frameworks most used already by the financial community, including the TCFD, that's the Task Force on Climate-Related Financial Disclosures, and the SASB standards from the Sustainability Accounting Standards Board, that's industry-based standards, and making them into a global baseline directed at the financial markets. So this, in answer to your question, what's driving it? First of all, it's the tremendous need to be able to direct capital, but it's also a convergence of the needs of different stakeholders. So investors now recognize diversity or climate or other issues like, say, cybersecurity as business risks, and they need information on them. Whereas in the past, maybe they served different niche audiences. So we're now at this tremendous shift. We're moving from qualitative to quantitative, that is from stories to numbers. And we're moving from voluntary to mandatory, with many jurisdictions around the world putting in place rules for ESG disclosure. That requires common, streamlined reporting language, and we're finally getting there.
Great. Thanks so much, Michael. And I might just build on, it's important that you mentioned we're talking to the investor relations professionals here. And I'm sure, their job really is about communication and transparency. And many of them are kind of wondering what they're supposed to be doing now. So would you have any advice to the IR professionals listening to us today? What is their role in this shift and what can they be doing?
Okay, well, let me pick up then again, the shift from stories to numbers and the shift from voluntary to mandatory. What that's doing is bringing ESG data up to the level of financial reporting in terms of the rigor of its preparation, in terms of its importance in its use. That is when ESG data is being used for financing decisions, when it's being used for executive remuneration, for due diligence around M&A, in all of those cases, you need a tremendously high quality of data. So that means from the investor relations point of view, that they have to bring to ESG reporting the same discipline in terms of processes and controls, data governance, verification and audit very often in order to ensure the quality of this data, in order to make sure that it can be used for investment decisions, for investor voting decisions, but also for management and board decisions. So I like to call it investor grade data, but you could also call it director grade data. So what does investor relations bring to this? They bring that financial reporting expertise, and also for that matter, the engagement and the communications with shareholders, which is central to this new landscape.
So I like that idea of investor grade data. And since we have an investor with us today, Michael, maybe we can talk to you a little bit about how that data is being used. You've been using this data for quite some time now, and I'm sure you don't want just an influx of as much data as possible. So can you talk to us a little bit about how investors are using the data that companies are now providing? And for example, the climate related risks and opportunities, or the TCFD data that we're asking for, what do investors do with that?
Tiffany, all great observations, questions you've laid out there. And I look at it as an investor managing both public and private capital for large sovereign wealth funds, institutional investors, and managing funds. We take data, we take a very harvest as much data as possible to gather a robust data set. And then what we do is we have an internal factor scoring methodology, ESG insights factor methodology that we use to weight and rank and measure. And if we take a look, for example, at a company like a publicly traded company, NextEra Energy, it's a utility. We utilize various data screens as well as weightings and factors to identify a company like NextEra, that's a solar energy company, renewable energy company. We're identifying some of not only the front office, middle office, back office activities and operations, but how they're conducting themselves and what their scores are internal with employee treatment and engagement, vendor engagement and interaction, and how they're treating their vendors and pricing and competition. And so we know that when we assign an internal score of, for example, 93 on a publicly traded utility like NextEra, 100 is perfect, 0 is the lowest possible. NextEra scores a 93 out of 100. Their composite score reflects one of the highest utilities in the investable universe of 122 utilities that are focused on serving consumers in electricity and power generation. So we're utilizing the data to inform us of the front office, middle office, back office operations, to inform us of the company's responsible investment policies for solar. And as you can imagine, people think of solar, it's something that's environmentally friendly, but you have various elements of the energy material supply chain, silicon, as well as other types of chemicals that are involved in production, manufacturing, industrial applications to generate power for consumers and the delivery of power and electricity to consumers. There's a whole host of things in that energy material supply chain that could potentially be at risk. So taking data and helping us manage and measure internally to allocate capital, which we look at every dollar of capital being scarce, and trying to make an informed decision to allocate capital thoughtfully to what we believe to be the best-in-class companies that are yielding the highest sustainability scores, ESG scores. And we believe that return on capital will reward us for investing in a thoughtful, sustainable manner with the companies that are the most thoughtful and sustainable in terms of their ESG or sustainability scores.
Right, very interesting, Michael. I might just pick up on what Neil was saying with investor grade data and needing to have kind of rigor and verification and assurance. How do you ensure the quality of the data you're receiving to, avoid greenwashing and all those terms we hear so often? Is there anything that the IR team can do to communicate how their data is developed, or to assure you that the information is quality information?
Yeah, I think, Tiffany, interesting question, right? So it's not unlike being an athlete where you train for an event, you train for your competition ongoing. And so the amount of time that you spend on cardio or weight training, and it's an iterative process where you get stronger, you get faster, your results in competition become better, whether you're a marathon runner or you're playing soccer or cricket your fitness level, your athletic ability is predicated upon how much train, how much practice, how much time you put into it. And as a data scientist, data professional, the more time you spend on the data, you can scrub it, you can analyze it, you can push and pull the data multiple ways. So then that way you feel like you can have a scrubbed, robust, clean data set, in which then if you have a robust and thoroughly rigorously scrubbed or analyzed data set, you can actually make thoughtful choices. And also the iterative process of benchmarking. I think Neil touched upon some interesting things. When you look at data, you can use it for a whole host of things, but I think having a standardized set of factors, having a standardized methodology for going about preparing the data, having investor grade data of the highest quality and the highest integrity. And really that comes down to one of the key principles of accounting, right? When you take a look at accounting for hydrocarbons, you take a look at the accounting for various underlying factors, front, middle, back office. The accounting is the underlying factor of which the integrity of the data helps you make a more informed decision. And I think the IR professionals, they know more than they've forgotten more than I'll ever know about their jobs and responsibilities. In IR, being able to present the data so it's bulletproof, so it's really robust, but the integrity is there to withstand the scrutiny of not only money managers, but hedge funds, as well as what we're seeing now more than ever is private equity or private capitals coming into the public markets. They're looking at companies and they're acquiring publicly traded companies and taking them private because of the valuations are so attractive right now, because of the accounting methodology is so transparent, and the corporate governance at publicly traded companies is much better than some of the private companies, so that public companies are now becoming targets of some of these larger private equity firms. And you can just see just in some of the transactions, I'll give you an example. There's an Italian toll road operating and transportation airport operating company that Blackstone just put in a bid, and they've acquired a publicly traded listed infrastructure company. They did so because it was a family-owned business. It had transparency. It had standard audited financials. And it was a very attractive company because of the operating assets and the governance and the model of the company was such that it was very transparent and attractively valued. So these big private equity and private investor firms are coming and acquiring publicly traded companies because they feel like they're getting the robust data, that IR is preparing robust data in an investor grade way, that it's clear and transparent. The accounting is thoroughly scrubbed. So they feel like they're getting an asset that's attractive and at a fair value.
Great, thanks, Michael. And Neil, before we move on to the next section, I wanted to pick up on one other thing you mentioned in moving from qualitative to quantitative measures here. Now, there's certain things we can't quantify. And if we look at, for example, the TCFD and looking at kind of the governance, which is, corporate governance is so key to the processes of alignment within our organization. Where do you see the role of these qualitative disclosures, and how should we be seeing those evolve over time?
Yeah, that's a great point. And don't get me wrong, qualitative is not going away. And indeed, that's another area that investor relations really brings their strength to, is to be able to continue developing those messages and being able to communicate them. There is around, whether it's around governance or indeed around strategy and risk management, around these key content areas of reporting today, there is a very important place for that qualitative information, and be able to communicate the strength of the board, the skills of the board, the values of the company, and how those values connect to the strategy, the purpose of the company, and how that connects to strategy and to risk management and so on. So yeah, no doubt there's a very important role there still for that narrative reporting, and for the important role of investor relations, and able to be developing those messages and communicating them.
Great, thanks, Neil. And we need to go to that alignment space still. Our question here was to talk about both the stakeholder capitalism and then the aligning the frameworks. So we've touched on it a little bit. I want to hone in a little bit more on that if we can. And Michael, I might come back to you to build on what you just mentioned of needing kind of this alignment and shared understanding of what enterprise value is and why it's important to investors. So we keep hearing that we don't want more data, we want better quality data. Can you unpack that a little bit as what is better quality data and why is alignment so important for that?
So better quality data, provides us with a solid foundation for decision making. I think the auditing trail and auditing process, whether you're talking financials, whether you're talking the enterprise value of a company, I think it's 2022. We've had a pullback in the equity markets in the last few months here. I think what we've seen over the last 10 years with accommodative monetary policy has been, to a large degree, risk-seeking behavior in the capital markets of investors, institutional as well as retail investors. And a lot of this capital that's been injected into the markets post-COVID to try and get the economy back on track has not only gotten some of these economies back on track, but it's created asset inflation and created an inflationary regime where in 2021 we've seen stock valuations be beyond what anyone could expect to be a premium. I lived through 1999. I saw the tech wreck. I saw excessive valuations. I looked at enterprise value and valuations back then. It didn't square. I look at a company like Tesla, albeit trying to deliver, admittedly, cars that could solve the energy material, conundrum. When you look at electric vehicles, something that's a noble purpose, but existing stock price of Tesla would inform an investor that each Tesla vehicle is $2 million each. So when you talk about enterprise value, you talk about stock price. It doesn't square with some of these companies, despite the fact we've had a massive pullback. And so I think when you're looking at enterprise value, you're looking at the underlying financials of the company, and you're trying to build models, whether they be discounted cash flow models or other types of company models. And you're looking at free cash flow, level and direction of margins, reporting on dividends and dividend payout schedules. That's the other thing that I think if you were to go beyond technology, but into other types of industrial companies and dividend paying stocks, sustainability is also about an enterprise value. When you're drilling down, looking at a dividend payout ratio of a company that pays anywhere from a 20 to 60% dividend payout ratio. We've seen companies paying higher than 60% dividend payout ratios. That to us is a red flag in which we believe that dividend payout ratio is unsustainable. And if they continue to take money in the form of debt and investor capital in the front door and then out the back door, they're paying a dividend payout ratio of 80, 90, they're paying out excessive dividends as opposed to retaining them and investing and prudently managing their balance sheet. The enterprise value gets distorted. And I think we're admittedly now with the inflationary regime shifting, you've seen a little bit of a pullback in stocks, you're seeing enterprise value and you're seeing company valuations be adjusted. And a lot of the research professionals at these various houses that cover equities, they cover various companies globally, they're adjusting valuations and they're re-examining enterprise value of companies, saying, where are we missing things? Where do we need to revise our earnings model? Where do we need to revise our company models? And let's look at enterprise value of the company and maybe take a step back and reevaluate how we're doing things. So I think this is a pause and opportunity for IR professionals to really spend some time with the research houses that cover these various companies and spend time with them on enterprise value, spend time with them on their front office, middle office, back office, how they're doing things internally at the company to show how they're creating value.
Great, thanks, Michael. And Neil, you're right at the center of this, of creating kind of convergence on enterprise value. So I might ask you to look forward a bit and into the future. Where do we see this space moving to? What can we expect to happen, not just in the coming months, because it's changing so quickly, but in the coming years ahead of us?
Sure. Let me bring you up to date. So the ISSB has been set up as a parallel board to the IASB. It will be issuing standards to be used, focused on the information needs of investors around sustainability, to be used worldwide in conjunction with IFRS, the International Financial Reporting Standards, which are used in Turkey, or other accounting standards, such as US GAAP. Okay, so in that sense, accounting standard agnostic. The two first exposure drafts have been issued for public comment, and I'd call upon all businesses in Turkey to make themselves heard, to have input into these exposure drafts. The ISSB has already responded to market demand by taking the key frameworks and standards, including TCFD and SASB, and building them into these new standards. We need continued input into this process. The public comment period closes July 29. Now, what's the next step? We anticipate and we hope that standards will be finalized before the end of 2022. IOSCO, the International Organization of Securities Commissions, as well as the IFRS trustees, have indicated that's the timeline they want. That will mean that these standards should be ready and in place for companies to begin using, at least on a voluntary basis, in the next reporting year, 2023. Now, it will, of course, take time for them to then move into rulemaking in different jurisdictions. We expect that to happen as well, in the same way that IFRS spread around the world to 144 countries, including Turkey. We expect to see the ISSB standards spreading around the world. But well in advance of that, investors are already expecting companies to begin using those standards when ready. Why is that? Because they are the next evolution of TCFD and SASB, and investors have very strongly coalesced around the TCFD recommendations and SASB. Now, one more element to point to, and that is that the ISSB, in taking the building blocks approach, still provides for the flexibility for jurisdictions around the world to build upon this global baseline. Recently, the IFRS Foundation announced an MOU with the GRI. The GRI standards are used for more multi-stakeholder reporting about impacts on the planet and society that don't necessarily relate to enterprise value. Now, the interoperability between those standards and the standards for sustainability-related financial reporting are extremely important. So we will be working on that interoperability with GRI standards. What this means, looking ahead into the next 5 years, is we will get to a streamlined system, a global baseline of high quality disclosure of sustainability related financial information for use in investors in their decision making, and for use by companies in helping guide their strategy and mitigate risk and achieve some tremendous goals that are incredibly important that we all share.
Thanks, Neil. If I can just take one more minute of your time. One more item I wanted to address is where this information appears. With the TCFD, we've moved from putting this information into our sustainability reports to pulling it more into our financial filings. What do you see? So is ISSB then aligning with that push of getting this information into our financial filings, or where do we see this information appearing?
So this is a key point. Now, the ISSB can't say exactly how and where this information should appear, because that may vary depending on different rules and laws in different countries. However, what the ISSB standards do say is that they need to appear in the general purpose financial reporting directed at investors. So that might be, it could be in a related report or on the website, as long as they're tied into the suite of financial reporting, because that connectivity is so important. And then the other key aspect of connectivity is that this reporting, according to the standards that we've put out for public comment, should appear at the same time. Now, that's incredibly challenging currently today with the state of ESG data, but it's so important given that investors do need to integrate this information into their decision-making around the financial statements. So this information has to appear at the same time as the financial statements in the same reporting package as the financial statements. And that might be in the future an integrated report. It might be a new model of report that will bring together the financial statements and sustainability-related financial reporting together.
Great. Thanks for pulling that all together for us, Neil. We're already out of time. This went way too quickly. I could keep throwing questions at you guys all day, but I really appreciate your time. Just to sum it up here, I think what we've been finding is that, stakeholder capitalism is really the search for true enterprise value. So it's not that we're asking for a bunch of more information now, but we really actually have the knowledge, the data, the science to be able to integrate more information into our strategy and to make more smart strategic plans as organizations. So this should be key to the investor relations community, which comes down to really alignment and communication and trust in that information. Thanks so much for both of you being with us today. Thanks so much to the Turkish Investor Relations Society, and I hope everyone enjoys the remainder of this Sustainable Investment Summit. Thanks, everyone. Have a great day.